All right, so here we go. We've got some Chapter 10 multiple choice questions to work our way through. We have 9 of these. So these are posted to our Canvas site as well. But here we go. All right, so Jackson is a 30% partner in a partnership, and he sells his entire interest for $112 cash, $112,000 cash. At the time of the sale, his basis is $64,000. He doesn't have, the partnership, doesn't have any debt or hot assets. What is Jackson's gain or loss on the sale of his interest? Okay, first, let's talk about one term and let's talk about hot assets. Hot assets are either inventory or accounts receivable if you're a cash basis partnership, okay? Or depreciation recapture is also a hot asset. So hot assets, if there is a percentage or a portion of hot assets, then that is going to cause your gain to be ordinary in nature as opposed to capital, okay? So what we're asked about is gain or loss, okay? And so how do we figure out gain or loss? We look at amount received and we compare it to basis, and that gives us their gain or loss. So what did he receive? He received $112,000 of cash. His basis was $64,000. The difference between those things is $48,000. And we know, since there are no hot assets, that gain is capital. All right? So that is the answer to number 1. All right, and I don't remember if I put these all on separate pages or if I have 2 to a page, so we'll just have to, there we go, we got 2 to a page on this one. All right, so here is a conceptual question. Which of the following statements regarding the sale of a partnership interest is false? All right, the seller's primary tax concern in a partnership interest sale is calculating the amount and character of the gain or loss on the sale. All right. The selling partner determines the gain or loss as the difference between the amount realized and the outside basis in their partnership. Well, that sounds good. Hot assets change the character of a gain on the sale from ordinary income to capital, and any debt relief increases the amount the partner realizes from the sale. All right, so any debt relief increases the amount the partner realizes from the sale. That is exactly true. Okay, the selling partner determines gain or loss as the difference between the amount realized and outside basis. That's also true. We just did that in problem 1. Okay, the seller's primary tax concern is calculating the amount and character of gain or loss. Sure, hot assets change the character of gain. We know that is true. All right, but they don't change the character from ordinary to capital. It's the opposite, right? They change it from capital to ordinary. So C would be the false statement, okay? All right, let's look at number 3. All right, so in number 3, at the end of the year, Cynthia, a 20% partner in the 5-person CYG partnership, has an outside basis of $30,000. Okay, so that's the basis in their partnership interest, including a $15,000 share of debt. On January 1st, she sells her partnership interest to Roger for a cash payment of $22,500 and the assumption of her debt. CYG has no hot assets. What is the amount and character of Cynthia's recognized gain or loss on the sale? Okay, so again, to figure out gain or loss, we have to look at amount received minus basis. All right, and what did she receive? Well, she gets $22,500 of cash But what did she also get? She also got debt relief. Okay, so she also receives $15,000 of debt relief. Okay, what was her basis? Her outside basis was $30,000. So the difference between those two things is $7,500. She received more than her basis, so it's a gain. And then is it a capital gain or an ordinary gain? Well, we know that there are no hot assets, so it has to be a capital gain. All right, that is number 3. Let's move on to number 4 times. There we go. All right, number 4, which of the following assets would not be classified as a hot asset? Okay, we know that inventory is, we know that depreciation is, we know accounts receivable are, so cash would not be a hot asset. All right, now moving on to number 5. All right, so let's check out number 5. All right, so we know that SSC is a cash method partnership, and we've got a balance sheet there for them. And so they have cash, they have accounts receivable, and they have land, okay? Susan is a 1/3 partner, and she has an adjusted basis of $90,000 in her partnership interest. She's going to sell her entire partnership interest to Emma for $120,000 cash. We need to figure out how much capital gain and ordinary income Susan must recognize from the sale. All right, so before we even look at the numbers, let's look at the nature of things, okay? So how would we get ordinary income from the sale? Well, we'd get ordinary income from the sale if we had hot assets, all right? And which of these items on our balance sheet could potentially be a hot asset? Well, that's this accounts receivable, right? It told us that she's a cash method taxpayer. The other things that could be hot assets are inventory and depreciation recapture. We know that land doesn't get depreciated, so it's not going to have depreciation recapture. We know that cash is never a hot asset, so we've got this accounts receivable amount sitting out there. All right, we'll deal with that in a minute. All right, so the first thing we need to figure out is how much gain she recognizes on this sale. Okay, so again, we have to look at amount received minus basis. Okay, and what did she get? She got $120,000 cash. Okay, and what was her basis in the partnership? Her basis in the partnership was $90,000. Okay, so what does that give her? That gives her a $30,000 gain. Now we have to figure out, is that going to be ordinary or capital? All right, so now we have to look at our balance sheet again, okay? This balance sheet that we're given is for the partnership, okay? So the whole partnership, all the partners have $60,000 of receivables, okay? But what is Susan's share of receivables? Remember, her share of receivables, we care about that because those receivables are hot assets. So it's 1/3, whoops, I just wrote 1/2. 1/3 of $60,000 equals $20,000, okay? So Susan has $20,000 of hot assets when she sells that partnership interest, okay? So since we don't have to allocate that $20,000 between assets at all because there was only one hot asset, all right? And we know that she's got $30,000 of total gain. So of that $30,000 of total gain, $20,000 is ordinary due to the sale of her share of the hot assets, and then $10,000 is capital because $10,000 did not come from the sale of the hot assets. And so that then shows us what type of gain, the character of her gain that she is dealing with. So the answer to this question is D, because she has $10,000 of capital gain and $20,000 of ordinary gain. Whoops, I hit the button too. All right. Now we get to go on to number 6, and number 6 is very similar. All right, so here is a similar type of problem. So we've got Susan again. We've got a partnership balance sheet, okay, with accounts receivable, which again are hot assets. And Susan is a 1/3 partner, and she has an adjusted basis of $90,000. So that's her outside basis in the partnership. She's going to sell her entire partnership interest again to Emma for $100,000 cash. Now we have to figure out the amount and character of Susan's gain or loss on the sale. Okay, so let's start the same way. So we look at her amount received minus her basis. Her amount received is $100,000 cash. Her basis is $90,000. So her gain is $10,000. Now we have to figure out if that gain is ordinary or capital, okay? So now let's take a look in here a little bit more, okay? What do we know? Again, we need to look at Susan's share of hot assets is 1/3 of $60,000. So her share of the hot assets is $20,000, and that would be a $20,000 ordinary gain. All right. But when you're looking at this, what do you notice? Well, she only got a $10,000 gain and she has a $20,000 ordinary gain. So that seems really, really odd. Okay. Well, so here is an interesting situation. Okay. So she has to recognize her share of ordinary income. All right. So she has a $20,000 ordinary gain. Okay. But the total gain is only $10,000. So how do we adjust for that? Well, the way we adjust for that then is she has a $20,000 ordinary gain, and she ends up with a capital loss equal to the difference between the ordinary gain and the total gain. Okay. So her situation at the end, I'm going to stretch this a little bit. I'm going to leave, well, how about this? How about I switch colors and leave that visible? I guess you guys can replay it if you need to. Okay. So what is her total situation? Her total situation then is a $20,000 ordinary gain and a $10,000 capital loss, okay, in order to come up with a total gain of $10,000, okay? So from a multiple choice perspective, then the answer is D, okay? So that's number 6. All right, so now we've got number 7. Daniel is acquiring a 30% interest in a partnership, and he's buying this for $39,000 of cash. The partnership has borrowed $10,000 of recourse liabilities as of the date he bought his interest. We need to know what is Daniel's basis in his partnership interest. So we're interested in his outside basis. All right. So what is his basis? Well, so his outside basis equals purchase price plus his share of liabilities. Okay? So think about that as if he were just donating stuff, if he donated cash, right? His outside basis in the partnership would be the basis of the property that he contributed plus his share of the liabilities. So his purchase price plus, and then what is his share of liabilities? He's buying a 30% interest in $10,000 of liabilities. So then his outside basis is $42,000. All right? And so that's answer B. Okay? All right. And now we have 2 left. We have number 8 and then number 9. All right? So here we go with number 8. So we've got this partnership, and they're a cash method partnership, and we've got their balance sheet. Okay? And so now we're just trying to find their hot assets. And we've talked about hot assets already. Okay? And this is section 751A. So what is that? That's just a portion of the Internal Revenue Code that defines hot assets. Okay? So what are their hot assets? Okay, well, we know that they're a cash method partnership. So we know that accounts receivable are a hot asset. Okay? We also know that depreciation recapture, okay, is a hot asset. Okay? So what do we see about their equipment right here? Okay? We see that their basis is $40,000 and their fair market value is $50,000. So that means that we have $10,000 in depreciation recapture. Okay? So where do the hot assets come from? Their hot assets come from accounts receivable and this depreciation recapture in the equipment. Remember, land can never be a hot asset. Cash can never be a hot asset because there's no depreciation recapture in either land or cash. Okay? And then number 9 is our last one. So here we go. So we've got Shauna. She is a 50% partner in this partnership. She sells 1/2 of her interest to Kara for $60,000 cash just before the sale. Her basis in her entire partnership interest is $150,000, including $60,000 of partnership liabilities. And then we have the partnership's balance sheet right there. All right, so what we need to do is find the amount and character of her gain or loss on the sale. All right, so same as before, we need to look at the amount received minus her basis. Okay, and what did she receive? She sold her partnership interest for $60,000 cash, plus her share of debt relief. Hold on, I got to get my pencil working again. But remember, she's only selling half of her interest, okay? And her total share of partnership liabilities was $60,000. So if she only sells half her interest, that means her debt relief that she is selling is $30,000, okay? And then what was her basis? Her basis in the entire partnership interest was $150,000. So her basis in the half interest that she's selling is $75,000. So now we have to figure out what her total gain is, okay? So her total gain is $90,000 minus $75,000, which is $15,000. And that's her total gain. All right, now we also have to figure out what her, whether it's a capital gain or at an ordinary gain, right? So we need to look at these things, okay? So when we look at her balance sheet, what do we see? Okay, we've got land, that is not a hot asset. We've got cash, that is not a hot asset, excuse me. We have inventory, that is a hot asset, okay? So what do we need to do? We need to look at the appreciation of those hot assets, okay? So hold on, so we need to find her share of the, well, let me rephrase that. We don't need to find her share. What we need to find is let's say that a different way. Find the share of the appreciation of the inventory that she sold. Okay, so what did she sell? All right, she had a 50% interest. She's selling half of her 50% interest. So Susan sold 25% of the hot assets, okay? So what was the total appreciation? Total appreciation of hot assets equals 180 minus 60. Okay, and then she sold 25% of that. So let's find what the 1/4 of 120. So 1/4 of 120 is $30,000. Okay, so what does that represent? So that means she has $30,000 of ordinary income, all right? And so now we have to compare that. Compare her $30,000 of, ordinary income to the total gain. And remember, her total gain, we said up here, was $15,000. So $30,000 ordinary income minus $15,000 total gain gives us what? Gives us a $15,000 capital loss. Okay? So what does she have then as a result of the sale of her half of her partnership interest? She has $30,000 of ordinary income and $15,000 of capital loss. Okay? And so if we go back up here and look at our options, we see that option A is $30,000 of ordinary income and $15,000 of capital loss. All right? And those are our Chapter 10 multiple choice problems. Thanks, guys.